All right, welcome everybody. Thank you for joining us today. I'm very excited to have Logan back from Forecastr. This is a series that we've been doing for over a year now, and the more we do it, the more people show up and the more good feedback we get and the more good questions that we get. So we're probably not going to stop anytime soon. We're actually in the middle of our Grow series of founder education. So Grow is all about, you've already kicked off a company, you have incorporated and you have your founding team put together. Maybe you've actually raised a little bit of money in terms of a pre-seed, put your own money into your company just to get those initial paces going. But now everything is about that fabulous word, traction. So if you're going to talk to investors, you're going to talk to partners, you're going to talk to whatever, you need to grow and develop traction, and traction leading up into fundraising. And if you've attended some of our other events with Forecastr, the financial modeling aspect of a startup is one of the most useful ways to communicate both internally to how your company's doing and if you're actually making significant traction, but very importantly, externally to people that are going to join your efforts, specifically investors. So this webinar is all about how to use a financial model to impress investors and close checks, raise checks. What are those things?
Close checks. Something.
And so if you've seen some of our past programming, we focused on how to kind of go from 0 to 1 with a financial model. So this one does assume that you have some semblance of a financial model. And how is it different? Obviously, when communicating with investors, you don't just do the exact same thing that you do with your founding team. It's a whole different lens and a whole different perspective. And Logan's going to run us through that. And yes, we are recording this. Please use the Q&A features. You can use the chat. I think I might have to open up a second. No, it looks like it's open. We also have Calvin here who's going to help us out, answer questions in line and in chat. And this should be pretty good. We'll have ample time for Q&A at the end. And I might interrupt Logan a time or two throughout the presentation. We will send the recording out within a couple of days. It's taking us a little longer because we got a lot going on. So please be patient with my inbox when asking for the recording immediately after this closes. And with that said, Logan, take it away.
Thank you so much, Ryan. As usual, that was a glowing introduction. Much appreciated, and happy to be back here for another iteration of how to leverage your financial model to impress investors and close checks. So this is one that I really love getting. So I'm really excited to be back here and talking with you guys about this. We give a lot of content here at Forecastr around financial modeling, the value of financial modeling, the value of FP&A, so financial planning and analysis. And I've said many times that the true value of a financial model really boils down into two areas. One area is helping you identify the levers of your business and really supercharge your operations, and really unlocking your business is like a secret weapon of where can I make the highest impact? A financial model can be very helpful in that regard, but it can also be very helpful in using the story that it's telling to pitch investors and then get them really excited about your business so that they're going to want to write checks and keep you funded. We're really going to be focusing on the other half of that today. We're going to be focusing on how to use a financial model as your secret weapon whenever it comes to fundraising. And we'll continue to do webinars with Gust so that we can talk more about how to supercharge your business and all of that good stuff. But this one's all about fundraising. I'll kick things off by telling a very brief story, just to kind of show you that the proof is in the pudding with some of the stuff that we're talking about here. So the idea of Forecastr came to be in 2018 when me and my co-founder, Stephen, were working as fractional CFOs. And whenever we decided that this was something that we wanted to do, whenever we had the idea and we got really excited about it, we knew that it was going to be a fairly capital-intensive business to build. I mean, you're essentially replacing Excel whenever it comes to a major business function, which is no easy feat. So we wanted to raise money on the front end before we were generating revenue, which kind of presented the all too, I think, typical dilemma for startup founders, where it's, I need to raise money, right? I have no traction, I have no revenue, I have no customers, I have no nothing, but I need to raise money to make my dream come true. So whenever you're doing that, whenever you're finding yourself into that situation, you really need to rely on storytelling, and you need to rely on storytelling in a very specific way, in a way that gets investors really excited. Now, luckily for us, me and Stephen were both finance people. So we came together, we put together our financial plan for how we could turn investor dollars into more dollars. So we were thinking through things like, what business model do we need to use? What does our CAC need to look like? What are our revenue targets? What does the LTV need to be? All of these things. Now, remember, we never sold a dime. We had never brought in a single customer, but we had thought through everything at a very granular level. We had put it all together into a financial model. We then use that to pitch investors. And fast forward, We ended up oversubscribing that round. We wanted to raise 600,000. We actually raised 750,000 with no traction, no revenue, no nothing. And fast forward today, we've got 33 employees, 1.5 million of revenue, and we're off to the races. So I share that just to say that there's no silver bullets when it comes to fundraising. It's always going to be hard work, and it's always going to be a grind. But if you're smart about it and you kind of unlock these things that are going to help you speak to investors more clearly, then a round's going to get done that much easier. And this is what we're going to focus on today, is the financial aspect of that and why that's so important. So I did talk a little bit about my background to go a little bit deeper, just because I think it's important for you all to know kind of who you're talking to and what gives me the right. I'm a finance guy through and through. Before I started Forecastr, I was a fractional CFO for a number of years, worked with dozens of companies from pre-seed up into Series B, helped them raise millions of dollars. Forecasters in total raised about $5 million to date, 630 clients thereabouts. So suffice it to say, I know the finance game better than most folks that you're likely to meet, and I've also fundraised, and my co-founder Stephen has done the same. And we touched on what Forecastr is a little bit, but what Forecastr is essentially is it is a online integrated web app that is taking the art of financial modeling away from Excel and bringing it into the 21st century using technology. So the way that I like to describe Forecastr's value is that if you look at every publicly traded company, every large middle market company, you're going to notice that there's this department that they all seem to have in common, which is called an FP&A department, which stands for Financial Planning and Analysis. So what these people do in these departments is they use math, they use formulas, they use kind of like their metrics to try to understand and try to streamline business to the best of their ability, and use finance as their weapon in order to do this. So these are teams of people that are going to go in, they're identifying the key levers of businesses, they're trying to run real-time scenarios to try to optimize businesses, and then put the output in front of investors to help them make decisions. If you're a startup or if you're in the private market, you don't really have the budget to be able to afford a team of people that are going to help you do this. And that's really where Forecastr comes in. We're kind of a blend of software and services. We take a human approach, but we use our tech to help put together a really great financial model, which is the cornerstone of FP&A. We stick around to help you understand it, help you actually use it for your business and operations and fundraising. So it's really our way of bringing FP&A from the private markets or from the middle market down to the private markets into the venture-backed ecosystem. So if anybody's interested in learning more about Forecastr, you want to talk to our team, you want to get a customized demo, Calvin, if you want to go ahead and throw a link into the chat, that's the best way to get in touch with us. Just fill out this quick application and we will meet with you very, very quickly. So just to do a real quick agenda. So we're going to talk about why should we care about financial modeling? I like to start there, right? So why do we care about it? Why are we talking about it? Why do we have a whole series? Why did I build a whole company around it, right? So we're going to start with that. Then we're going to talk about, once you've got your projections set in stone, how do you loop them into investor conversations? So we're going to talk about how to use it in a pitch deck, and then how to actually present it to an investor in a meeting. And then we're going to use that. We're going to use a real world example to kind of articulate that. So I'm actually going to take you all behind the scenes. We're going to go into Forecastr's financial model. This is the financial model that we are actively using to pitch investors right now. I'm going to take you through my flow, and then we're going to, end it off with a decent amount of Q&A. So just so you all know, this is going to be probably from here, maybe 30 more minutes of content, and then we're going to have probably 15, 20 minutes worth of Q&A. Me and Ryan always like to go long on that, so we should be able to fill that up pretty easy. So
This is true.
This is definitely true. Okay, so at the start, we're going to say, what is a financial model, right? That's the highest level that I could take us for this presentation of just why, and maybe to even expand it, why should we care, right? Why are we all here? Why are we all trying to learn about financial modeling? And why do investors care about financial modeling, right? Very common sentiment. And I'm sure that there are people in the audience right now that are thinking this. Why does it matter? Everything that I put in the financial model is wrong anyway. Anything that I have 5 years in the future is completely fictitious. So it's a useless exercise. Nothing about this matters. I'm just doing this to check a box for an investor, right? Hopefully that's not the case. But, investors don't like giving busy work to founders, and founders don't like doing busy work. So we're going to talk about the value of a financial model and why we should all pay attention to it and why we should all focus on it. So to do this, to hopefully convey, the value of it, why we should care about it, I'm going to use an analogy that was actually crafted. I've got to give credit where credit is due. Troy Hinikoff, he was the former MD of Techstar Chicago, came up with this analogy, which we have since stole from him, but I think it's a really good one. So I'll share it with you all now. So if you're looking at my slides right here, this is kind of showing the very early days of the design phase of the car manufacturing process. So this is probably back in the, I don't know, 1950s, 1960s. I'm not really 100% sure. But essentially, if you wanted to create a new car, the flow would go something like this. So you have an engineer that would take pen and paper. They would draw out the schematics of the car. They would try to get a sense of what it would look like, get a sense of measurements, things like that. Then they would do kind of what you're seeing on the right-hand side of my screen, where they take this giant hunk of clay and they would sculpt it down all the way down to the component level, where you can really get a sense of like weight distribution, what it's going to look like, the aerodynamics, like all of that stuff. It's all going to be done out of clay. Once that's done and you have a good sense of kind of what the end result's going to look like, then they're going to take it and they're going to translate that clay sculpture into rubber and metal, and they're going to create an actual working vehicle. So once that's done, then they're going to find somebody that's going to have to jump into this new machine. They're going to put it on a track and they're just going to see if it works, right? They're going to put it on a track and they're going to take it around and they're going to put it through a series of tests and they're going to see how this new car performs. Now, sometimes that's fine. Sometimes it would work great and sometimes there would be no issues and it would be off to mass production after a series of testing. But a lot of times there would be issues because this is a completely new thing. Any kind of innovation, right, by definition, has never been tested before. So you're putting it out in the universe and just seeing if your idea worked. So every now and then they put it on a track. They try to take the sharp 90-degree turn to test it, and the car would flip over into a barrel roll and it would explode and it'd be this big, huge disaster. And you would have to go all the way back to the drawing board and you'd have to start the entire process over, all the way back to the pen and paper. And then you have to take it back to the clay and then you have to do it again and again and again. And by the way, not only is this time consuming, not only is this expensive, it's dangerous. I mean, the guy is literally in the driver's seat testing the car and you could be really hurt if something goes wrong. So it's pretty wild by today's standards. I don't think you have to be an engineer for you to immediately understand why this is a bad process, why it doesn't make a lot of sense. You're wasting a lot of time, you're wasting a lot of money, you're wasting a lot of energy building out these early models, and you're literally risking lives in the process. So things have evolved since then, thankfully. Nowadays, cars aren't built in the same way. They're built soup to nuts using software before any kind of physical prototyping is done. So you can build a car and you can design and test that car in minutes instead of months and years. So you can all the way down to the component level, all the way down to the very screw where you used to do it in kind of clay and then you'd have to build it. You can do this in technology, and then you can take that virtual car, you can put it on a virtual track, and then it can literally in seconds run thousands of simulations under thousands of variants of different conditions to understand how the car would, in theory, behave in the real world. So it can do way more comprehensive testing because of scale of software than you could ever do in the physical world. And if something happened, right, if you take that sharp 90-degree turn and the car flips over, not only will you know that there's an issue, it can actually zoom in and tell you where the point of failure was. So it can say, hey, that new screw that you tried to like put in, it didn't hold the weight, it shattered and it caused the car to flip over. Would you like to increase, the width of the screw or whatever, something like that. It can identify it and then you can just, once you fixed it, put it back on the track, click a button, rerun the simulation until you get it right. And then you go and you build the prototype and then you put it on the physical track and then you take it to mass production. So the idea of doing full physical prototyping without any kind of software testing is it's not done by today's standards. It's considered laughable. And we think that this is a really great analogy for financial modeling and FP&A in general, because using technology in the same way those people back in the 50s or today, we use technology to help streamline the car design process. In this way, you can simulate your business and you can run tests on your business in minutes instead of years. So you can see what happens once you've got this built, the financial model built. You can see what happens if you add a new product line, or maybe you try a new marketing channel, or if you wanted to build out an entire sales force. Or if you're really early, like we were, whenever we were first raising our first round, You can understand, is my business viable? Or what goals do I need to hit? What does my pricing need to be? What does my CAC need to be? What sales channels can I support? More theoretical things that are still really, really important. So in a sense, what you're doing is you're saying, can my business handle the sharp 90-degree turn? Is it going to flip into a barrel roll? Where will the points of failure be? Right? These are the types of things that you're asking whenever you're building a model. But because it's done in a simulation, if there are issues, you don't get hurt, your investors don't get hurt, your co-founders don't get hurt, you're not spending a ton of money or time, and it really gives you a chance to optimize before jumping in headfirst and wasting a lot of time and money. So this is kind of the heart and soul of why we're so passionate about financial modeling and FP&A, because if you do it right, and if you spend the time and you invest in it, at the end of the process, you're going to have a working full simulation of your business, which is one of the most powerful business tools that you have. And in my opinion, it is the most powerful business tool out there that is the least utilized. So because of the power of having a working distilled mathematical simulation of your business, you can imagine why people are interested in that. You can imagine why investors would be interested in taking a look at that, because once the simulation is built, you can ask the simulation any question that you like, and you get very educated answers on those types of questions. So if I'm a business owner, I like that because I can ask the simulation how best to run my business. What happens if this happens? Do some cause and effect type of stuff. But if I'm an investor, I also am going to be interested in the simulation because it's going to answer a lot of the questions that I have. What do your targets need to be? Where are you spending money? Things like that. So I put on some of the biggest questions onto this slide that a financial model is going to help you answer. But there's a lot more than this. So common ones you guys probably already heard. How much money should you raise? And how are you going to spend the money and things like that? A lot of times we found that founders kind of stick their finger in the air and say, I'm going to raise $5 million. I'm going to raise $1 million. I'm going to raise $500,000. But if you push on it, you're like, but why do you need to raise that much money? Then a lot of times founders realize that that's not really the amount of money that they need to raise. They just kind of heard from somebody or just assumed that that was roughly what they wanted to raise. You may find that you can build your business with a lot less money. You may find conversely, it's going to take a lot more money whenever you really are honest with yourself. So a financial model is going to really kind of put pressure on that question, how much money should you raise, and help you answer it and help you think through where you're going to be spending that money so that you can kind of get a sense of like why you need to raise that amount of money. Hiring plan is a big piece of that. But then the other one is just scale-based questions. So if I'm an investor, let's say I'm an investor in a pre-seed round, or we'll say a seed round. One of my biggest questions is what does the business need to look like for you to get to maybe $1 to $2 million of annual revenue, right? Why is that a question that I want to have answered? Well, if I'm investing at the seed stage and you're in a venture-backed company, I'm assuming that you're trying to make your way to a Series A. I know roughly what a Series A company looks like. It's probably $1 to $2 million of annual recurring revenue. So I want to see how many new customers you need to have to get there. What does your churn need to look like? What does your pricing need to look like? Things like that. So I can get really comfortable behind that. All of this stuff is answered in a financial model and so much more. So a lot of times we're asked by founders, specifically whenever we're talking about projections that investors are asking for, a lot of times founders will ask, when should we invest in a financial model? When should we spend the time, the money, the resources into putting these sets of, projections together? A lot of times we hear companies say they feel like they're too early. They don't have enough data. They don't have enough of their business figured out. Anything they put into the forecast is going to be wrong. We've heard it all. So I'm going to give you our advice and, make your decision based off of that. But in our experience, if you have a financial model at the seed stage and below, it's more of a separator between you and other startups. So investors, whenever you're very early, you're raising kind of your first rounds of funding, they don't necessarily expect you to have the most polished, most buttoned up financial model, the most tuned in FP&A function whenever you're that early. And we've certainly seen rounds get done without those companies having financial models. I mean, they get done all the time without financial models. Now, that being said, We're in 2023 right now. You may argue that this is one of the most challenging fundraising environments since the early 2000s. Standing out from the crowd today more than ever is going to be really important while fundraising, especially if you're really, really early on, if you're kind of like a idea or very low revenue stage company where it's very, very crowded and you're competing with a ton of different companies for investor dollars. So you got to kind of put yourself in the headspace of an investor. An investor sees hundreds of deals a week, and their job is to say no to pretty much all of them. Their job is to find the best of the best, the absolute cream of the crop. That's what they're trying to do. So your best chance of success in getting a round done is try to eliminate all areas of risk, or as best as you can in an early stage company. And financial risk is one of the biggest areas of risk whenever it comes to early stage investing. So, I already shared our story about how we leaned on our model and ended up oversubscribing our round back in 2019. And it's a great way to kind of stand out of the crowd and build confidence. The mindset that I always try to be in whenever, especially during challenging environments, but really at all times when it comes to fundraising is this something that a top 1% company would do, right? If I'm out there fundraising, I'm competing against 100 other companies that are pitching these same investors. I got to be the best one out of all 100. You don't get there by being lazy. You don't get there by trying to skirt by and do the bare minimum and seeing what you can get away with. You get there by leaving it all out on the field and leaving absolutely no stone unturned. And that's why, it's our recommendation just to invest in financial modeling early on. And at the Series A, you're going to need one anyway, right? Once you make it to a Series A, it's completely table stakes. You've got to have it. I've personally never seen a Series A round or above get done without some form of financial projections. I'm sure somebody in the audience has seen it get done. If it does happen, it is like super, super rare. It's a part of due diligence at the Series A and above. Your analysts are going to want to dig into it. So it's our advice to go ahead, invest the time, effort, and energy early on in a financial model. And then it's going to pay dividends later on in the process. So
I'm pretty sure peak 2021, an NFT based business model could totally raise a Series A without a financial model.
Yeah, I mean, they get you pretty much don't even have to do anything. I think you just the money's in your bank account at that time. Yeah.
But I do want to pick out one thing, and I think this is very applicable to life and startups overall, is one of the best ways, especially if you're coming from if you're a first-time founder or you're coming from a background that doesn't have all the connections in the business or people to sort of like shuttle you along to these things, is if you look at what is required for the next round and sort of back up to that, it really increases your chances of your other round. So like Logan says, it's table stakes to have a financial model and projections at Series A. So that means if you have them at pre-seed and seed, everything becomes easier. Now it is more work to put those things together, but that fits into pretty much our entire philosophy. It's like, it's table stakes to be a Delaware C Corp at a Series A. You would have been forced into one if you ever did a seed round. But if you're there when you start, it actually simplifies a lot of the things. There's far less conversations that end with you still had some stuff to take care of before you come back and we actually talk real business. So the more you can kind of be aware of like what's around the corner, the more you can make moves in the present to increase or to decrease the friction really of getting deals done, whether that's fundraising, contracts, partners, customer sales, kind of across the board.
Big time. Yeah. And that's a really important point, Ryan, is like one of the things that's going to inspire a lot of confidence while fundraising. Like, let's say that you're at the seed stage, right? If I can point to you a financial plan that shows I know exactly where I need to be to get a Series A done, I know exactly how many customers I need, I know exactly what my revenue needs to be, I know exactly what my churn rate needs to be, and an investor can look at that and be like, yep, if they have revenue of this, churn of this, unit economics of this, a Series A is getting done. And it's like within maybe 18 to 24 months after my seed, which is an appropriate time frame. It's really going to inspire a lot of confidence, right? So it's really just a signal. At the end of the day, it's a signal to the investor. I know what I need to do. I understand my business. I understand the market, and this is my plan to execute it. And it's mostly just a check the box from an investor standpoint. From an operator standpoint, it's a lot more than that. But from an investor standpoint, it's a kind of a check the box type of thing. Cool. Okay. So now I want to get into kind of how do I loop this into a conversation with an investor? So we've talked about the value of a financial model, how it's a simulation for your business. We've talked about roughly when you should start to think about financial modeling, when you should start to think about investing in a financial model. So now we're going to assume that you've got a financial model, you've invested the time in the process, you have a set of projections, and now you're about to go hit the fundraising trail. So you got to ask yourself, how am I looping this work that I've done into the conversation? How do I pull this in? How do I best leverage this to make it my, secret weapon whenever it comes to fundraising and help get the deal done? So we're going to talk about that here in a second. Before I get into it, though, for those of you all that aren't there, that don't have a financial model, that don't have a set of projections, we want to help. At the end, we'll offer a discount if you want to work with Forecastr, because we can certainly get you there. But if you're very strapped for cash super early on, we still want to help. Calvin, if you want to throw the templates that we have into the chat, that's a really, really great starting place. We have templates and resources that you could use as like a starter. That should be really, really helpful. But moving forward, we're going to talk about it as if you've got it built. So whenever I talk about a pitch deck, right, it's probably what everybody's thinking about whenever I talk about a pitch deck. I'm talking about the concise, 8 to, I guess it doesn't really, like 8 to like 12, 8 to 15 slide deck. The small, you know what I'm talking about.
Yeah, don't get into the 30s. 15 is probably the max.
15 would be the max. Yeah. I think ours is like 10 or something like that. So the concise pitch deck, the pitch deck that you use kind of in early meetings with investors. So I want to talk about how to leverage a financial model in that document. Now, the key to showing financial projections in the deck is it is our recommendation to have a slide dedicated to the financial future of your startup. We believe that it warrants its own slide with a few caveats. So the key to putting a financial projection slide into your pitch deck is to keep it high level and don't go way too deep into the weeds. That's like the biggest caveats I can give for that. Now, the reason for this is that you really want to focus at the early onset of the meeting in building emotional buy-in for your company. Like the purpose of an early investor meeting is not to get married on the first date. And that's not the purpose for you. That's not the purpose for the investor. The purpose is to get to know each other and hopefully get the investor excited, get them emotionally bought in. You want them to be very, bought in about the problem you're solving, about the idea, about the team. If you have traction, about the traction. It's a very emotional thing, early stage investing. It's not like the stock market where you've got 10 years of historical data that you can plug in your Excel sheet, do all kinds of work to figure out if it's a good investment or a bad investment. If it's early days, you're literally investing on emotion, you're investing on gut, you're investing on kind of like faith. So that's how you need to treat it. You need to spend the early days in the meeting getting that emotional buy-in, getting the investors kind of like excited. If you plop down a full-on financial picture too early, it's going to take the conversation from an emotional conversation to an analytical conversation too soon, right? It's important to have the analytical conversation, which is why the financial model is important. Don't do it too early. Don't do it too soon, because that's going to take the conversation down a path where you don't want it to go at a time where you don't want it to go there. So this is actually a sample slide of the financial projection slide that Forecastr used in our pre-seed round. So I'll note that this is probably more information than the average startup should even have on a slide. We were a financial modeling company, so it's on brand for us to have a little bit more numbers to go a little bit deeper. So if you're not a financial modeling company, which I assume pretty much nobody else on here is, our recommendation is even just a graph with some like big pictures of important numbers like, year 5 revenue, gross margins, things like that. Things that are interesting that paint the picture of a big opportunity, right? That's really all you're trying to do, is show this is a big opportunity and you should continue to look at this opportunity with me. So just to kind of like recap, Keep it high level because you want to focus on getting emotional buy-in. That's really the key in the early meetings. You want the slide there, but you really want to focus on getting emotional buy-in. You don't want to go too deep too early because it's going to take the conversation off in a weird place. But where it becomes your secret weapon when it comes to fundraising is that you want to show the slide, you want to paint the picture, you want to show that the opportunity is massive, and then you want to use that slide to get a hook for your next meeting. And if you do it right, it works like a charm. So if you put a slide, a good financial projection slide together that shows this big opportunity that whets the appetite for the financial picture, that shows that you thought through it, that shows that there's logic behind it, savvy investors, good investors will want to dig in more and understand them. You want them to look at that slide and say, where'd you get those numbers? Like I want to understand this. So you're wanting to do this, you want to do that. Okay, like what's going on here? Let's talk about that. That's what you want to do. That's really the purpose of it. Once they ask this, that's your chance. That's your cue to set up a separate time specifically dedicated to this, which is going to lead to more face time with the investor. And that's going to lead to more trust, right? I always say that, and people who have fundraised before know this, it's a game of building trust. That's it. Like investors invest in founders that they trust. And trust is primarily built through two things, which is familiarity and confidence. And if you get a meeting set to go through your financial plan, it's going to build both of these things. So another meeting with the investor, that's going to lead to more familiarity. It's just more time on the calendar for you all. You're going to get to know each other better, right? And what you're doing is you're going through your full-on financial plan to show the investor how you're going to take their money and turn it into more money. That's a very confidence-building meeting. It's you showing that you know your numbers, and it's going to show them that you're going to be a good fiduciary of their investment. That's why this meeting is so powerful. If you can get them to this meeting, this let me show you my full financial picture of what the future looks like meeting, if you can maneuver that meeting well, you're going to see an incredibly high close rate on the investors that you get into the room for that meeting. Right? And we've seen this time and time again.
And I would be remiss to not mention the previous slide that you showed, minus the EBITDA, which is definitely more in your wheelhouse as financial people. That is exactly the resolution of financials on your Gust profile. Mm-hmm. Because every angel group we have hundreds of angel group across the world. They want to know the rote, simple things about a company. And it is basically like revenue growth over time, expenses, and potential profit. And that is what they care about to size the opportunity. But that is just to start the conversation. The additional diligence clearly happens once the interest has been lit. And like Logan said, where'd you get those numbers is probably a great question to lead to a second meeting. Or if you're applying to investors on Gust, actually getting in there to pitch them in a more organized fashion.
Big time. Yeah, that's a really great point. That's kind of the secret sauce when it comes to this stuff. You want it to be just big, like you want them to look at it and be like, that's a big opportunity. And the math is spinning in their head. They're looking at that. Okay, $80 million in 2026. Okay, how many customers is that? At what price? Okay, what is that? I wonder what they're. And then they're going to start asking you questions, and you get to look. I will walk you through all of this. Let's set up another meeting for 2 days from now. We'll go through all of this and all that. That's where the magic happens. That's the secret sauce. So we talked about like kind of like how you use that to get that next meeting and why that's so important. So now I want to talk about how are we going to execute that next meeting. So this is more of just like my tips on, how to get that meeting done, how to like think about it, how to prepare for it, things like that. So we're going to talk about that now. Then we're going to go through Forecastr's financial model, and then we'll open it up for Q&A. So I kind of break this down mentally into the 3 phases of any meeting, which is before the meeting, during the meeting, and after the meeting. I think it's helpful to kind of think through things sequentially like that. So before the meeting happens, I will say the first part is you want to be prepared. So this is well before the meeting. You want to invest the time to make sure that you know what your financial model is saying, to make sure that you know how it works, make sure you know what the important metrics are, make sure that you know what it's saying. Your job in this meeting is to inspire confidence. It's hard to inspire confidence if you don't understand your own financial model. So that's the number one before the meeting happens. This is all a part of your fundraising prep in general, though. Once the meeting is set and once you're about to meet with them, our recommendation is that you do not send them a copy of your financial model. Now, I know that this can be somewhat of a controversial opinion. We feel very strongly about this here at Forecastr. You don't want a financial model to live on its own. You want to be in control. You want to control the narrative, and you want to present the financial model to the investor in person or on a call. So this is going to do a couple things. One is it's going to give you leverage to get the next meeting, which is important because a lot of people don't want to meet with you. They don't want to spend time. They just want the data, right? They're like, just send me the model. I'll look at it. It's fine. If they're interested in your business and they want to dig in, they can do that as much as they'd like. But the one stipulation that you have is that you need to be in the room and you need to present them with the financial model. It's going to give you leverage if they're really interested. It's going to weed them out if they're not really interested, and it's going to get you in the room with them if they are really interested. So that's one. It's going to give you leverage to get the meeting set. Number two, it's going to demonstrate your understanding of the model when you do present it, right? So if you've done the prep work, then you're going to come off of that meeting looking really, really great and understanding the inner workings of your model. And if you remember the analogy, if I show that I understand my model, what I'm really doing is showing that I understand my business, right? My model is a full-on simulation of my business. So the two directly translate. If I know exactly how my financial model works, I know exactly how my business model works, and I know all of the important levers. So that's going to be another piece. It's going to be confidence inspiring. It's going to show that you understand your business. But really the most important reason that we recommend not submitting the model is that it gives you the opportunity to control the narrative. So this is just kind of basic human psychology. If you send an investor, really anyone, any piece of material, be it a pitch deck, a financial model, data room, whatever, they're going to get it in front of them and they're going to have some sort of reaction to it, positive, negative, or neutral. They're going to, form their opinions about it, whatever. You want to be there while their original opinion is being formed. You want to be there while this is happening so that you can control how the opinion is being formed. So it's really easy for an investor to get the wrong impression of a financial model if they don't have context. And it's like anybody, it's like anything. If I have pause about something, if I look at a model and I'm like, I don't believe those numbers, I don't think that this is right, I don't think AR is right, things like that. Once my mind is made up, it's really hard to change my mind. I've got to fight, to try to get you to change your mind once you've actually formed an opinion on something. Versus if you're there while I'm first seeing it, I'm able to change how your initial reaction is being formed. I can shape it. So where I was in a negative place, if I'm in the room, maybe I can just get you to land in this positive place rather than having to start from a point of negativity and drag you over to this point of positivity. It's just basic human nature. It's hard. It's easier to form an opinion than it is to change it. So, and by the way, if you're there and you know your model and you've rehearsed and everything, you can probably get most anybody to a point of a positive reception to your model because you know how to pitch your business and you know how to talk about the metrics that you know are potentially going to cause problems. So be there. You want to present your model. And when you're doing that, whenever you're in the meeting, be in control. So at this point, you're prepared. You know your model, you know your business, you've got the meeting, you're sitting in front of them and things like that. For whatever reason, people still go into these meetings and they're very nervous. They're very intimidated by these meetings. And they think it's like, I'm going to battle up against the investor. They're going to tear my model to shreds, ask me all kinds of crazy in-depth questions. But don't let this happen, right? You know your business better than the investor will ever know your business. And if you spend the time, you know your model better than they're ever going to hope to know your model, right? In this same span of time. Treat it as a working session. You and the investor are working together. You're using the model to analyze your business. The way I think about it is it's an opportunity to get two smart people together looking intensely at your business for a finite period of time. So you're going to present what you and your team think is realistic. One of the tricks that I like to say is when I present my model to an investor, I say, look, the number one thing we can both agree on this financial model is that there's a 0% chance that it's correct. Right? There's a 100% chance this financial model is wrong. So I'm not going to sit here and tell you that this is going to the T happen. It's a done deal type of thing. This is me and my team's best estimation. This is the goals that we're striving for. And this is what we think is possible given the constraints that are defined in the model. And I want to talk about that with you today. That's how I like to approach these types of meetings. So you can present what you think is realistic and you can show that you value their input. If they have questions, answer them. If they have hesitations, or if they're like thinking that your growth is too aggressive or things like that, treat it as a conversation, respond to their ideas, offer some of your own, present, and you can brainstorm as well. So if you know your model well and you do the preparation, then this shouldn't be a scary model at all. And if they catch you off guard with kind of like an in-depth financial question that you don't know the answer to, that's totally fine. Don't stress it. Just say, that's a great question. Here, let me write that down. I'll get back to you, tomorrow once I talk to my team about it. That type of thing. Just be ready for that. So be in the meeting, be in control. After the meeting, always follow up. This is one of those other things where it's like, what would a top 1% company do? A top 1% company always follows up. Summarize what you talked about in an email. Then you can include the copy of the financial model. Once they've got the context, once they've met with you, then they can go through the model however much they'd like, because they understand at this point what the model is saying. So a couple other key tips here. If they asked about a new scenario, maybe they were like, what happens if you lean more into services? What happens if you tried more paid ads? What happens if you did that? Spin up a new scenario really quick and like put together what they asked for, and then send it to them and be like, oh, by the way, interesting comment you had about paid ads. I actually ran a quick scenario with that. If you want to check it out, here it is. Pretty interesting. And you can even say, if you want to set up another meeting to dig further into that, explore it more, we can do that. Boom, there's another meeting, right? And that's really what you're trying to do. Get more face time, build more trust, things like that. And this is also your opportunity. If they asked you an in-depth question you couldn't answer right away, talk to your team, get back with them after that. So at the end of the day, what you're trying to do is show them that the model meant something to you, it was productive, and that you value the time and that you respected them. Right. Okay, I'm going to try to go through this relatively quick because I want to make sure we got plenty of time for Q&A. So now what I'm going to do is I'm going to go through our financial model at Forecastr, and I'm going to walk through at a very high level how I like to think about walking through our financial model whenever it comes to investors. So there's a secret approach, not secret. I mean, I talk about it on pretty much every webinar. There's an approach that I use that I call the zoom out, zoom in method whenever it comes to presenting my financial forecast. So I call it zoom out, zoom in, because what I like to do is I like to start with the pot of gold at the end of the rainbow to get everybody excited. So I start on the income statement. It's an annual income statement. And what I'm showing you is this is a massive opportunity. That's like kind of the punchline of this view is we're going to be doing, this model that I'm about to walk you through is our strategic roadmap for how we're going to get to, in this case, close to $90 million in 2028. At that point, you're kind of flirting with $1 billion valuation with stabilized margins above 30% of net income. So this is a big business, is a great business. And what I'm going to do is I'm going to walk you through how we're going to get there. That's the zoom out. Start zoomed out, show them the opportunity, show them the pot of gold, get them excited. And then I flip over to the assumptions and I say, now I'm going to flip to monthly and I'm going to walk you through step by step, me and my team's plan on how we're going to deliver this value to you. So I start with customer acquisition. It's answering the question of how are we getting new customers into the door? And it's going to, inspire a lot of confidence whenever I show that, if we look at April, I'm hoping to get 63 new customers. If I expand each of these, I can show you all of the assumptions that my team uses in order to ensure that we hit these numbers. So I know how many partnerships I need, how many leads I need to get from them, what conversion rates need to be. My director of strategic networks, he's in charge of owning this metric. So he's in charge of reporting on this, and his comp is even tied to these targets. So it's a high degree of success that we have in hitting our forecast, right? So it's that type of stuff that's gonna kind of afford a lot of confidence in the process. Then I flip over into how are we going to turn these dollars into revenue? So I can go in here and I can talk about our different packages and things that we offer. And this is also where I like to kind of loop in our accounting integration. So I can show that, we run a really tight variance on our revenues. This is a direct pull from our QuickBooks. In February, we had a 0.03% variance on our revenue forecast. So we're very tight on variance. We're really good at forecasting this type of stuff. So it's just kind of like another way to kind of like showcase, that we actually know what we're doing. Then we can go to the people section, talk about all the different people that we plan on hiring. So it goes, this is how we're going to be growing. These are how we're going to be turning those customers into dollars. These are the people that are going to be doing this. And then these are the other expenses that we have in order to get this done, right? So that's the type of stuff that we want to go through. I always like to end on the equity section and then talk about the fundraise. So you can see here that we've got a financial, like we're raising $4 million essentially. So it's like we are raising this money so that all of these great things can happen. Everything that I just talked about will not happen if we don't raise this money. So this 4 million is essentially paying for that $90 million of revenue and things like that. And you can even show that kind of on the statement of cash flows by showing, what happens essentially if you don't raise that $4 million. So you can see here, if we don't raise we're raising the 4 million right here. There's the 3.5 that we're raising. And that's going to essentially flip us over into profitability. So that's really what we're doing here. So that's Forecastrs in a nutshell. I will end it here by saying, first of all, thanks y'all for sticking with me. I want to offer $500 off of a first-year annual subscription whenever for Forecastr. That's going to come with a 30-day white glove onboarding where an analyst is going to be paired up with your account. They're going to help you build the financial model, show you how to use it, help you get operational value out of it, all of that good stuff. If you have any questions about it or you want to learn more, again, just use that link that Calvin dropped in the chat, or Calvin, if you want to drop it again, that works too. And with that, we got about 13 minutes, so we can kick it off into some Q&A.
So you had some general questions of, before we jump into the detailed ones, how much does Forecastr normally cost annually? What does the discount get them? And what is the white glove worth?
Great question. Okay. So there's a couple of different packages when it comes to Forecastr. The base package of like just getting into the software, getting onboarded, things like that, is $2,000 a year without the discount. So with the $500 discount on this call, you would pay $1,500, and that would be it'd be $1,500, and that would include the white glove onboarding. So that would include an analyst that's paired up with your account. These people are experts at financial modeling. So most of them are used to work at VC funds or ex-founders themselves. So they're going to help you think through your unit economics, help you understand what investors want to see, and help you kind of leverage the model to help supercharge your business. But that base package, the $2,000 package, that's essentially us onboarding you and then you owning the model after that. If you want to do kind of more of a plug and play FP&A type of thing where we own the model, we build it and own it forever and keep it updated, give you reports on it, help kind of advise you with it. We have a package for that too. That's $5,000 a year, and that'd be $500 off of that package as well. So $500 off of either package.
Excellent. All right, so I'm going to go through time order. Somebody anonymously asked, how do you differ from Vena FP&A Solutions? I'm not familiar with them. Are you familiar with them?
Sure not.
If they're
FP&A popping up every day.
Yeah, if they're FP&A Solutions, it sounds like they're probably just a FP&A staffing firm, and they don't actually have software behind them to allow this to actually be something that's in your hands.
Yeah, I would say generally I can kind of answer this question. We actually pride ourselves on being kind of unique in the market. We're kind of unique in two ways. So one way is that we're unique from fractional CFO, fractional accounting firms in that we have tech that makes us way more efficient, so we can charge less and deliver more value because we own the tech and have the tech. But we're also different from other just financial modeling kind of software companies because we take a human approach to it. So we can onboard you with a white glove, or we can continue to advise you and manage the model. So that's kind of like our sweet spot. It's like we have amazing tech that's really great that our customers love, but we take a human first approach so that we can help advise and make sure that you're getting value out of FP&A, which is really what we sell.
And I will take this opportunity to say why we like Forecastr so much is they are so very similar to what our approach is that second time founders come to Gust and Gust launch, and we almost never talk to them. They know exactly what we do. They see all the mistakes that will help them avoid. They set up their company, they fundraise, they run it, they manage their cap table, they do everything. I've had people who've been on our product for 5 years and I don't even know their name. But that's because they see it in the software and they've done this before. They've got the warts and the bruises from going it at the first time. But anybody else going in it for the first time or who's maybe run a more standard business than a startup, they can run into all those issues. And that's like, you have to have the human and the software at the same time and figure out the layer and where you can hand one off. And like Logan said earlier, is building trust. Beyond investors, building trust is pretty much everything a startup does, probably in its first half decade. trust in the people that run it, trust in the model that it's worth, trust in the quality of the solution, and trust in like where it goes eventually. And so both of our companies have that very similar thing. It's like we don't handhold every single customer that comes into our platform, because some just don't need it. They get it. But the ones that do, we make the space for it, and the ability to have software underneath there allows us the time to be able to actually, put the attention where it's needed most.
100%.
Nice technical question on Forecastr. Does it import existing financial models from a spreadsheet if they have like revenue, SG&A, COGS, staff, etc.?
So yes and no. It's a part of our process to import other financial models like from a spreadsheet, but that is included in the white glove onboarding. So it's not like a upload your model, press this button, and done. It's more like a send Nate your financial model, and Nate will get it back to you in a couple of days, but it'll match exactly what you have. It's just a part of our process.
Yeah. So it's an import, but it's not an automatic. You're not yet using scanning AI, understanding what all the intention of every tab, and every model is a little different if built. Yeah, I think one of the benefits of something like Forecastr is opinionated software. You can build anything in Excel, which means you can make infinite mistakes, but you can also build anything. And the reality of it is guardrails and constraints can be very, very powerful, especially when starting fresh.
Big time.
All right, next we got, is it fair to suggest that models are based, this is great, based on team experiences in the US? Financial cultures are different elsewhere, in particular the Western EU. Do you support non-US companies? Does the tool work? Does the service work?
Of course. Yep. 100%. So we can forecast in pretty much any currency at this point. We have customers, I think, on every continent. And we briefly had one that was that we had one login from Antarctica. Yes,
bell rings.
Yeah, exactly. We are global at this point. We actually have analysts based in the EU as well. We have analysts that are from India. We have analysts that are from London, and we work a lot with if y'all are familiar with New Chip as well, which is like they're known for kind of their global presence, like their non-US presence, and they're a big source of customers from us. So yes, we're very work with a lot of Indian companies, work with a lot of European companies, work with a lot of Asian companies, and that's no issue for us.
Awesome. You basically answered this throughout about, setting up a second meeting with investors after you getting that first attention. But Pete asked a slight nuance on this. If they want to dive in right now during the first meeting, would you still push for a second meeting, or do you feel like you could do it then and there?
It depends. You kind of got to read the situation. I mean, usually that second meeting, if run well, can be pretty heady and can take a little bit of time. So if you've got time and you feel prepared, then by all means, if the investor's right there and wants to dig in, then you can do that. I think I prefer trying to keep it to a separate meeting, just because I like to kind of mentally, segment the emotional buy-in. Okay, got that. We feel good about that. Now let's dig in and look at the investment opportunity and look at the future and things like that. That's a personal preference for me. I think it runs more smoothly, but if you feel like you can capitalize on that opportunity, then, by all means, do it then.
Yeah. And I will say, just from us, powering so many angel groups, often the first meeting, so investors get a lot of attention from founders, and depending on how you meet the investor, you just won't have the time. So I would recommend not doing it if they ask for I want to know specifically about that figure. Try to set up the second meeting. For example, New York Angel is one of the best run angel groups in, the United States, probably the world. They literally give their founders the 3-minute pitch, 10 minutes of Q&A, and then they go on to the next one, because almost all investors at that first meeting are just looking for, does this fit into my thesis, and is it scalable enough? If you waste time getting too specific, chances are the clock will run out and you won't get to say the offering, or why you're raising it, or how you're going to spend the funds, or any other part of your deck that you missed. But if somehow you have an audience with a hour-long, meeting or dinner with somebody, then you might have the opportunity. But for the most part, these 12 slide deck kind of meetings are usually pretty capped by another structure surrounding them.
Big time.
Let's see. We got Stephanie asked a really good question that you pulled out, Kelvin. And we get this all the time. They've seen investors pretend to be interested to get your information. Should we get investors to ask for an LOI, or I assume what is an NDA? I'm going to give this to you, Logan, before I give our common answer.
Yeah. Okay. Yeah. I'd be really curious to kind of like give your to hear your answer. I would say my advice is it's a tricky thing, right? Like if you're pitching investors, then there will be times where analysts or associates or whatever will want to dig in and meet with you just to get research to compare you to another portfolio company. Um, I would say I will pretty much never ask an investor to sign an NDA or anything like that. Um, One, because I think that they're somewhat meaningless. They're really, really hard to enforce. And also like investors typically just don't sign NDAs. Like they're just like, they don't have time for it. They don't want to mess with it and things like that. I would say, if you're meeting with a partner in a VC firm or something like that, they're probably not doing this type of work. They're probably not digging in and trying to like research and try to like compare you to a portco. If it's an associate or an analyst, maybe use your best judgment. I would say go in, research their portfolio if you're worried about it. If you see that they are invested in a competitor, ask them about it on the front end, and then you can kind of like gauge it from there. But yeah, Ryan, I'm curious to get your thoughts on it.
Yeah, I echo, like, do not try to get investors to sign NDAs up front. No way. I'm going to go back from like Series A to the beginning. Investors are literally looking, and Logan said this, looking at hundreds of companies a month. If they were to sign NDAs with every single company, it's not just that they can't be asked to do it. It's literally they would be crippled under legal, one, hard to enforce, but also like if you were to make a case out of it, anybody who pitched an investor at any time in the last 10 years could go sue them if they invested in a competitor. They could say, oh my God, they must have leaked our super secret stuff. There is not super secret stuff in a 10 slide deck. Never. Your idea has been replicated in the brains of millions of people across the planet. Now, the one thing that is specific is super detailed, patentable information about how an algorithm works. Maybe a physical device or medical device is totally something that you'd probably want somebody under NDA before you share them and say, this is how it really works. But what you can say is it works at the beginning of the pitch. You can say, I have invented a device that can do CPR on a person from 10 feet away without physical contact. And people will say, you are full of shit. And you're like, I swear to God, I've done it. Here's my financial model. Here's how it's going to change, the early responder industry. Here's how it all links up. I patented the technology. It's super secret. And if they're interested, later on, when you get deeper into diligence, it might be appropriate to be like, okay, but we've already had 2 or 3 meetings, and you're like, all right, I'm going to open up I found an infinity stone from the Marvel universe and put it in a gun, and now that's how I can do this kind of amazing thing. But now you can't tell anybody, please give me millions of dollars. Rarely does that happen. Some industries it does. When you get into VC land, often VCs will outsource, analysis to other members of their team who are a bit more technical, but you should be further enough along in the process by then that you will kind of know whether or not you should be signing documents in order to not share that stuff. But in the beginning, you want as much attention as possible. So do not be skittish about your business model, your company name, your purpose, what you're trying to do. Trying to get people to sign NDAs is a signal that you're probably a naive founder and you don't know how the industry really works, and you're going to be a pain to work with, because really ideas are almost worthless in this industry. It's all about execution.
That's what I was going to say. I was like, yeah, it's a great way to say that. It's just like ideas are borderline useless. Execution is everything. And I think like Nathan Latka even has a nice kind of like saying or whatever in his book. It's like ideas are worthless. Execution is everything. And he says, sign my NDA, people will never understand this. Like, like it doesn't, it's just, you need to convince them that you can execute because that's the important piece. So,
yeah. We're at time, but do you have some additional time? I have a tiny bit, maybe like 15 minutes, so we can get through these.
yeah, I have a little bit of time if people want to stick around and we can make our way through them.
All right. I hope this was obvious, but Anonymous asks, can you elaborate how this is more powerful than an Excel model?
Yeah, there's a bunch of reasons. I mean, it's an online, like my standard canned answer is online integrated web apps are just in general going to be a lot more scalable, a lot more useful, and for a multitude of reasons. I can kind of boil it down into a couple of different ones. It's really integrations, analytics, and reporting and collaboration. Those are the big 4 reasons that we're better than Excel. So integrations, we can power all of your financial model with your data. So, accounting is the past of finance, FP&A is the future of finance. Because we're in a tool, we can integrate those two so that they talk to each other. It's a major pain if you're working out of Excel, and that's something that we can do right away. Collaboration, you can manage different team members, you can set permissions, you can restrict things, you can set permissions by scenario. Another thing you can't do in Excel analytics, so real-time out-of-the-box variance reporting, things like that, unit economics reporting, we can do all of that. And then the reporting, we have dashboards, we have graphs, we have great stuff that makes things a lot easier. So those are the big 4 pillars. That's my 30-second answer because I can go really deep on that, but yeah.
Yeah, I think still the next decade is going to be full of people who have created spreadsheets in the last, from 1980 until 2010. There are thousands of SaaS companies that will do that better and more scalable. We've got a fun one. I'll actually answer this one real quick from Francois. Would you put your ask, as in what you're asking for fundraising, in that 8 to 10 slide pitch deck? I've been told yes, but I'm reluctant. I would say if you're pitching somebody, yes, end on that slide. That is the culmination of why you're there and what you're looking for. Do not end on a slide that says thank you or just has your logo or is cute. End on like, I'm raising this much money to put use to do this kind of things to grow the company in this way. If you're distributing your pitch deck to people and it might get into hands of other people that you don't know, maybe don't. Like, it depends. If you don't know where it's going to go, maybe not. Not honestly because anybody should really care about ideas and whatnot, but there are some sensitivities in fundraising around general solicitation and advertising a fundraising round with specific terms that you don't want to do. But do not shy away. If you're pitching to accredited investors, put that offering at the end because that's exactly why you're there. If you have any more to fill in on that, Logan.
Oh, that's great. I think that's exactly right. Nothing more to add there.
We got a good one. Forecastr functionality. Can you build multiple models and versions to like compare and contrast?
100%. Yep. Scenarios, you can build as many as you want, unlimited, unrestricted. You can clone scenarios, you can build new scenarios. So I'll just say, yes, that is covered.
This is a fun one. Logan, you might have built your credibility too well, but David asks, is this just the software and the service, or will you help me create a pitch deck and do a bunch of that work?
Yeah, so actually, yes, kind of, in a sense. I mean, it's a little bit outside of like what Forecastr does as our core business model, but we do partner with people. Gust, I know you all partner with folks too, but we have great people that we recommend for pitch deck services. We do offer fractional CFO services, and we have packages for specifically kind of like fundraise advising, things like that. So happy to chat with y'all about that if you're interested in that. So yeah, we try to, like, our lane is FP&A. Like, our lane is financial planning and analysis and financial modeling, but we work with a lot of early stage companies. So we make sure that we have good partners that can help with things like pitch deck creation. We've got discounts negotiated and things like that, as I know Gus does as well. So
yeah, I'll say companies like ours and Forecastr, like we're all trying to help startups out, and nobody like if anybody could invent the push button, help me get investment or help me craft the perfect pitch button, like that would be the company that would make me a billionaire. Everything is changing, industries are changing, business models are changing, but we all try to help out startups and we're all kind of interconnected. So certainly it's not going to be like, oh, this is going to take the work off my plate in terms of building my startup successfully. Like, no, it's you. You're the founder, you're the founding team. It is going to be fundamentally up to you whether you succeed, but we kind of help all along the way in terms of like, if you work with Forecastr, the financial portion of your pitch deck is probably going to be way better than if you were just trying to do it on your own, because you've leveraged those resources, but it's still going to be your pitch deck. It's still going to be your meeting to run. Same thing with Gust Launch and all of the services that we provide. I don't know if I understand this one. When you build the financial model, does your team input the market numbers in one's vertical? Is that what the 5K offers? I don't know. Do you know what that means?
Let me take a stab at answering that. Well, maybe I'll answer it in 2 ways and see if I hit with one of them. So whatever you're talking about, like, does the team put in kind of like their aspect of it? Yes. So like whenever I was going through our financial model and I was showing that like my partnerships manager has his number of leads that he has put in and his like targets and things like that. It is really good to get collaboration from your team and putting that together so that they know kind of what their targets are. So it is kind of a collaborative process, not only when it comes to building it, but also when it comes to just tracking it and making sure that it's up to date and things like that. So we can loop in whoever during onboarding. And with the 5K package, yes, we will keep that up to date. We will loop in the correct stakeholders. We can interface with your team and make sure that we get the correct numbers so that we can put the robust reports together and things like that. So hopefully that answered your question. But yeah, that's where the 5K package holds, I think, a lot of value is it's if you just need a model for a fundraise, which I don't recommend just using it for a fundraise, but if that's literally what you need, 2K package, that'll get you what you need. But if you're like, I want to like really supercharge my business, I want to dig in and like make FP&A a priority, which I think it should be, the 5K package is where you need to pay attention. So
Awesome. Next one's super easy. What integration do you support for actuals?
QuickBooks and Xero are the two right now, with many more to come.
Awesome. I didn't know Xero was there. Nice job.
Yeah.
Steph is back. Does you the question of the year,
I
does
know
it have AI?
Oh, does it have AI? Oh, I thought it was going to say, will it spit out evaluation? Yeah. No, it does not. Well, yes, it does. It does have analyst intelligence, because we do have analysts that help build it. So yeah.
Nice. For anybody listening, the absolute breakthroughs in LLM have yet to be applied to actually doing math. Although I found the most fascinating thing this week is if you ask ChatGPT to convert a Unix timestamp, it will get sort of right. And I think I have figured out why. Not because it's actually doing math, but because the Wayback Machine has imprinted the Epoch Converter website daily for the last 10 years. So there is data in human readable format of Unix timestamps and human readable dates, and it gets within about a day or four of converting it. And I think it's fascinating how LLMs could work and do that based on a body of human information. But that's for a whole other conversation. Oh, this is an interesting one from Samantha. Any advice on finding similar financial models from competition? She's in the research stages and building out.
Yeah. So financial models, no, I don't have a silver bullet for you on that. One thing that I would do, so I already brought up Nathan Ladka. He's actually, he's got a podcast that he does where he interviews founders and talks about like revenue and customers and things like that. See if your competitors have been on his podcast, because he can get some pretty in the weeds details, but it's not like a financial model. It's just like current financial details. I think our competitors were like, a lot of them have been on there. We got some intel, from that, but that's about all I got for you. I don't really have much of a silver bullet for you on that.
Yeah, it's probably always going to be close to the best. I could see some future in like 5 to 7 years where if you use HubSpot, you can see like HubSpot's like, yo, if you plug in your industry, we'll see if your open rates are better or worse than the industry averages by completely aggregating and not sharing any bad information. I could see a world of Forecastr being like, your business model's crazy compared to your industry, or 10 orders of magnitude more optimistic than most people in fintech, et cetera.
We're moving there. And Samantha, I just saw your what's the name of his podcast? It's the Top Entrepreneurs Podcast. If you just go into like Apple Podcasts or Spotify or whatever, you'll find it.
Awesome. All right. Do you help foreigners connect with investment, for example, from India?
Oh, yes, kind of, to an extent. That's not I don't want to get it twisted. Like, that's not like our core business. And I'm not going to be like, if you use Forecastr, you will get investment or anything like that. But we do, once you're post onboarding, we do have an offering that's called the Investor Connect offering, where we pair you up, or basically we put you on a list. If you want to share your data, we send that list out to a group of investors. We have like 150 or something angels or VCs on that list, and then they can connect with our companies, and we make connections every 6 months. So that's just kind of like, I would treat that as a supplement to your fundraise, not a, if I do this, I will get money.
Yeah.
But yeah.
That's both of our businesses. Like, yes, we can help you get funding, but not directly as your personal concierge or private banker who introduces investors and pitches for you and makes your business amazing. We provide tools and networks and exposure that you can leverage to get there.
Exactly. Yep.
This is a great question that I'm going to broaden to what happens a lot in early stage companies. I think it was Jennifer asked, how do you calculate CAC without revenue? And maybe in general, like, if you don't have a product in market yet, what good is financial modeling? Are you just making everything up?
Yeah. So that's a great question. So I would say, how do you calculate CAC without revenue? So interestingly enough, you don't actually need revenue to calculate CAC, because it's all marketing spend and like how many customers you get, things like that. But to answer, I think really what the heart of what that question is getting at, it's like, if you don't have X, if you don't have revenue, if you don't have customers, if you don't have costs, if you don't have anything, it's all theoretical, right? It's all like, none of it's real. So the question is it valuable if it's not real? The answer is yes, it is. And the reason for that is, even though it's not real, it gives you an idea of what your targets need to be once you're in the market. So like, I'll give you another kind of real world example with Forecastr. And maybe after this, we will jump because I probably do have to leave after this example.
Yep.
But, but it's whenever we were really early on, we were trying to figure out, do we want to be a freemium model where 90% of our customers are free and then we monetize the 10% that aren't? And do we want to scale that? And like, is that going to be our business model? Well, before we had customers or revenue, we did that math. We put together a financial model that kind of played that out. And before we decided to go down that path, we realized very quickly when we did the math, that's not going to work for this business, right? The amount of money or the amount of customers that we would need to get in order to support a freemium model, we'd basically have to get like 100% market penetration. And even then, I don't even think it made it to unicorn status. So it's one of those things that you want to put this together so that you have a framework for where you need to be. So you know, if my price is X, then I need to have my CAC less than Y. You know what I mean? And what does that look like at scale if I play that out? It just gives you a sense of like, when you talk to investors, you can be like, I don't have this, but I know where I need to be. I know where my churn rate needs to be. I know where my price needs to be. I know roughly how many customers I need to get in order to achieve the milestones that you're looking for, things like that. So it's just showing that you've thought through the experiment and you know roughly where the numbers need to shake out. So
yeah, I'm going to broaden that to answer most of the rest of the questions because they're all specific about like, what if we're biotech? What if we're any kind of business? What if we're pre-seed? With that, in general, these concepts are fundamental to business and economics. So it can pretty much work for everything. You can see from their templates, they mirror almost any kind of business, marketplaces, hard tech, direct sales, transactional only. You can distill all this down. Don't get spooked by CAC or LTV or this and that. These concepts, once you actually work with financial modeling, work, whether it's a restaurant, a high growth tech startup, an innovative new space technology company. Generally, this stuff can come down to a foundational layer and their software can support I don't think we've thrown anybody at them that their software can't support, but these principles can support this. And don't think that just because you're innovative, your business model is living outside of these economic principles. It just might be a unique take on them, which could make them very, lucrative in the future and create an innovative industry. But, be aware of these kind of things. It's the fundamentals of how economics works. And I think we got to call it there. I'm sorry if we didn't get to some of all the questions, but this was great. Fantastic questions as always. Really engaged audience. Logan, thank you for your time and your little bit of extra time.
Yep.
As we said, we've recorded this. We will share it out. Give me a couple days, probably early next week. It'll come out. We'll have a bunch of resources. We'll have the link to get the discount and the white glove onboarding courtesy of Gust. And there will be more of these. We're actually doing a financial model teardown within a month or less. We had a massive turnout for that in December where we take a real financial model, actually a couple from founders in our community, give them kind of a report card, and Logan goes through them and really just gives the kind of, I think it's a great example of all these questions. Oh, a hard tech company. Oh, I got a SaaS thing. I got a this and that. You'll see it with real numbers behind it. It should be really engaging and fun. And Logan, any last words?
no last words, but we'll see you all at the next couple of events. We do these every month, like Ryan said. So we're excited to keep them going. And thanks for the engagement. Thanks for sticking around for an extra 14 minutes. And appreciate it.
Have a great week, everybody. See you, Logan. See you, Colin.